Hey traders and investors, it's Serge Berger here. What we're going to take a look at right now is Twitter. I'm getting a ton of questions on Twitter, not surprisingly. With earnings last night, stock was down about 10 or 12% at some point early in the day. Now you can see we're chopping back and forth somewhere a little bit below the 10, a little bit less than 10%. I'm getting a ton of questions via Twitter and via the mailbag, so let's have a look. Basically, two scenarios, okay? Let me give you one scenario of not doing a trade in Twitter, which I think there's a actually really good argument for that, because a lot of people feel like they need to do something if a stock moves. Not always. And then number two, let me give you two potential trades that I'm considering in the trade, on both one on the long side and one on the short side. Let's have a look. Twitter, obviously coming to market last November, put in a low a couple of weeks after that, and that low this morning has been taken out. Okay, that's very simple. Now, the case for not doing trades is quite simple. Okay, this is a company just like Facebook when it came to market, and other companies like Yelp and those kind of things. They come out and there's new business model that really hasn't proved itself yet. It hasn't really proved itself yet. So these companies came to market because the getting was good, a lot of demand, little supply. That has changed over time. That was too much supply, little demand. But from that point of view, give the stock some time. If this stock really can't find itself at all over the next few weeks, then just forget it. But if it does kind of come together and give us some sort of bullish reversal, then by all means it might be playable for a bounce through the lens of a couple, 2-3 week time period. But until and unless you see that, I really don't think there's any great need to do something here. Again, this company still needs to prove itself, and unless analysts get their head around that, and then the company does, which probably isn't going to happen in the next couple of weeks, but there may be a new catalyst, I don't think there's a whole lot of stuff to do. Now, number two, let me give you a potential trade that I'm looking at on the long side. This is short to near term. I'm thinking of a trade of doing a couple days, holding a couple days to maybe a couple weeks or so, and that's quite simply selling far out of the money put spreads, okay, or puts. If you can stomach it, more risk averse people would do a put spread, which is where you'd sell, say, like a 35 strike put and buy like a 31 strike put, where basically your maximum drawdown is the difference between the credit and the difference in the strike prices. Okay, so I'm just looking at, I actually looked at this trade just a second ago on my nifty tool here. I got basically your maximum downside's around $31 in this example, whereas your maximum reward kicks in anywhere above, say, $35. Okay, so that's basically what this trade encompasses. The great thing about the case for the trade is that you're saying, okay, you're way out of the money, so you're selling a 35 strike put in this case, which is like 10% below the market, right? So this stock can fall down actually can fall quite a bit below 35. Break even's about 33.80 at the moment. So you're just betting on a bit of a rebound. The great thing about this trade is if this stock just goes back to $40, you can make a lot of money in just literally like a few days. Okay. The reason why this works well is because implied volatility tends to be quite spiked, and it currently still is. And so that's the reason for that. Now on the long side, on the short side, I think you have to be a little bit more patient. It's probably going to be one of those situations where this stock will need to consolidate a little bit, and then if it starts failing somewhere around the $40 to $41 area, if it bounces that far, then the short case may again become interesting for trading a stock back down to $35. That's a more this trade's going to take a little bit more time to develop. But you have very defined risk in both of those trades. If you want to buy the stock, you'll definitely be able to lean against today's lows. If you want to do a credit, a short put spread, like I just said, more or less the same story. And if you want to short the stock, again, take a little bit of time. Doesn't have to happen right away, and you can have a stop somewhere near in yesterday's trading range. Yesterday being April the 29th. I hope this makes sense. If you've got any questions, as always, you can shoot me a message via Twitter. My Twitter handle is SteadyTrader. Take care.